The board has also declared final dividend of 5 rupees per share on a face value of 1, in addition to the interim dividend of 5 rupees per share. I'll now run you through individual businesses. Despite constant chatter of the rise of discount brokerages, our broking business reported highest ever revenues, continued to gain market share, and saw highest ever quarterly as well as annual client additions. Market share improved by 30 basis points to 2.7% for the year. We added 225,000 new clients in the fourth quarter, which is up by 81%. We added 620,000 clients for the year as a whole, which is up 150%. The National Stock Exchange active clients of MOTILAL OSWAL registered a 50% growth to 564,000 clients. Distribution is an area of focus for the retail broking business, and the distribution AUM was at 128 billion rupees, up by 42% year on year. As we speak, 13% of the 2 million broking client base have been cross-sold a single product. We expect the AUM and the fee income for this business to continue to rise as we increase the proportion of customers to whom we have cross-sold and increase the number of products that are cross-sold. In the institutional broking business, the team was ranked number 1 best local brokerage house in Asia Money Poll 2020. Also adjudged as the best research team, best sales trading team, and the best corporate access team. We've seen improvement in our domestic client ranking and enjoy top 3 ranks with most of the institutional clients. Turning to the asset and wealth businesses, the asset management business AUM was at 457 billion, up by 54% year on year. Profits for the quarter were at 691 million, up by 94% year on year. For the year as a whole, the AMC profits were at 1.6 billion rupees and were flat on a year on year basis, impacted by lower average AUM due to correction in March 2020. Also due to cut in the TER in mutual funds. However, mutual fund yields have improved during the quarter, resulting in overall yield improvement. Private equity business has committed AUM of 66 billion across 3 growth funds and 4 real estate funds. We've launched IREF 5 with a target size of 8 billion rupees. Wealth management business AUM stood at 253 billion, up by 62% year on year. Revenues for the business grew by 45% year on year during the quarter and 26% for the year as a whole, led by strong net sales of 27 billion for the year as a whole. Our trail revenues continue to predominantly cover our fixed costs for this business. Turning to the home finance business, the business reported a profit of 184 million for the fourth quarter and 398 million for the full year. Profit includes very high tax rate on account of restatement of tax assets post migration to the new tax regime. Yield on advances remained flat at 14.2% in the fourth quarter. Cost of funds is down by 130 basis points year on year to 8.77%. Spreads have expanded by 123 basis points year on year to 5.4%. NIMs have expanded to 6.1% in the fourth quarter. Incremental cost of the 14 billion that we raised during the year averaged 7.5% versus 8.77% overall cost of funds. And hence we expect this trend of cost of funds to continue to trend lower. Loan book stood at 35 billion as of March 21. Disbursements grew 42% year on year to 2.7 billion. Salesforce expansion is currently underway as we look to ramp up disbursements. Gross NPS declined 75 basis points quarter on quarter to 2.2%. Net NPS stood at 1.5%. Collection efficiency in the month of March was encouraging at 97%. although these numbers will be impacted due to the second COVID wave. OPEX for the year was down 10% year-on-year, bringing down the cost-to-income ratio to 33% for the year against 41% in the last year. Tier 1 capital adequacy ratio was at 48%. Net gearing stood at 2.8 times and liquidity remains comfortable. Our fund-based activities include commitments to our own asset management products. Total quoted investments stood at 21.8 billion and including alternate funds stood at 31 billion. Our fund-based investments have registered sizable gains of 2.6 billion during the quarter and 7.7 billion during the full year. To sum up, this financial year has been a good year for us. Our capital market business has scaled up well, continues to benefit from industry consolidation, and also continues to make investments. Our institutional broking business has been ranked number 1 as local brokerage house in Asia Money poll. Our strategy to invest business profits in our own equity investment products has yielded favorable outcomes with net worth crossing 44 billion rupees. Asset and wealth management businesses remain big focus areas to raise their salience in the coming years. A lot of efforts and investments have been committed to home finance business. We are working to improve its return on equity and contribution to the overall profit pool. Judiciously deploying the capital accumulated through gains on investments remains an opportunity. We are now open to question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time.
Hello.
The first question is from the line of Prakash Kapadia from Unabridged Portfolio Managers. Please go ahead.
Thanks for taking my question. Congrats on the good set of numbers. I had a couple of questions on the asset management business. If I look at the PMS AUM, it is around 1 billion, around 15,000 crores. And this is same as it was 3 years ago. So is it some market share loss for us, or has industry in the PMS not grown, or some shift has happened? If you could comment on that. And secondly, on the CMC side, what is the percentage of passive funds to total mutual fund AUM as on FY21 versus FY20?
So as far as the CMS business is concerned, there was a big mark-to-market down last year ending March 20, and then there was a recovery in the current year, right? So the overall market performance itself, if you see over the last years, has not been significant. On top of that, there have been redemptions across the board, for active managers, whether it's mutual funds or PMS, and this business has gone through the same trend. Both of these factors have, impacted the overall AUM number that you spoke about. In terms of the share of passive in the overall business, our passive AUM is about 50 billion rupees right now.
As on this year end?
Yeah.
And this was what, around 15-20 billion last year?
Okay. That was actually 8 billion last year.
And Naveen, you mentioned about redemption, across the board. So it is not really market share loss. The industry itself as a PMS has not grown.
There are no market share numbers available for alternate assets, unlike for the asset management business where you have monthly clear data points that are available. But as you are aware, we had our own performance challenges, which has also contributed to the redemption, aside of the overall industry redemption trend.
Secondly, on the home finance side, you mentioned about, sales force being ramped up. So is there a possibility of AUM growth? And, if I look at the PPT on the collection side, we are seeing, consistent efficiency and repayment both. So what is leading to this? Because, I would guess this time around rural and tier 4 would be more affected. So could you give some color on that?
So we have set the house in order in terms of the legacy book, and you talked about the collection efficiency. We made significant investments in our collection team, which is nearly 500 people strong. We are now looking to ramp up our sales team because we are looking to ramp up our disbursements. I mean, the current level of disbursements of 2.7 billion are very small in the context of the 100 plus branches that we have, 105 branches that we have as of March 21. So, if you look at the industry rule of thumb of 20-25 lakhs disbursement per branch eventually, then we will need more feet on the street. There is definitely an issue about about COVID and its impact on disbursements, and but we are building this business from a longer term perspective, and the ramp up will happen gradually. Not that the entire ramp up will happen immediately. We will be increasing our headcount over the next 3 to 6 months time. But our clear ambition is to grow our disbursements from the level of 2.7 billion that you saw last year.
Lastly, on the broking side, if you could comment on, the banking partnerships, is that helping? Is, the online foray helping? Is it one account helping? And if I look at the PPT out of, around 2 million retail clients, 5.5 lakhs are active. So is it, active means one trade a year? How do we define active? And, it's around 27-28% of our total base. How is this for the industry? You could share some light.
Is Ajay on the call?
Yeah.
You can be specific. Yeah, Ajay, hi.
Yeah, I'm there on the call. So actually what we have seen is that on the broking side, the active client base surely for us is much better compared to the industry because we have got a very good advisory setup and the research base. So we have got a set of advisors. So I think for the industry it will be much lower compared to, but we will not have such numbers. The numbers which come out is only about the number of active clients, that is one trade a year. When you talk about active, it is one trade a year. That is how the industry is calculating it. So that is how the overall pie is. But surely we have got a bigger say into the whole thing because of our advisory setup, and we try to engage the clients not only to broking but also with all our distribution and asset products.
Right. And on the banking partnership, is there some specific banks which we have tied up recently for 3-in-1 accounts? Is that helping?
So we have tied up with multiple banks. AU Bank has been one of the big tie-ups, and we are tying up with multiple other banks also. But the ramp-up is mainly on the direct side in a big way. So we have increased the hiring. We have got more than 1,000 people hired in the last year. So it is mainly on the branch side where the hiring is happening, or on the branch as well as on the online digital side.
Thank you. This is the operator. Sorry to interrupt you. Mr. Kapadia, may we request that you return to the question queue for follow-up questions?
Thank you.
Thank you. The next question is from the line of Shalini Vasanta from DSP Mutual Fund. Please go ahead.
Hi, this is Vivek Ramakrishnan. All my questions are on the housing finance business, and so I'll just ask them in sequence. I noticed that 70% of your customers are documented customers, whether it's self-employed or salaried, and the yield on your portfolio is 14%. So the question is, where is the juice? Given that the mortgage is so competitive, would you see more business transfers going forward? Because your customers seem to be good quality or banking-friendly customers. So that was question number one. And second was, you're given the fixed rate and floating rate mix in your liability side, it is 65%. On the asset side, given the fact that it's already yield is 14%, is it all floating or is it going to be fixed at this rate because, the vulnerability increases if the interest rates start going up? And lastly, would you be able to give the constructed versus under construction mix in your home loan portfolio? Thank you.
Sure. Arvind is there. Arvind, can you talk about that? And maybe Shali can talk about fixed and floating kind of liability.
Yeah. Yeah. So, just to answer your first question in terms of, the profile of the customers that we have. So we have about 55% of our borrowers are salaried borrowers, and therefore, naturally, they come with documented income. On the self-employed side, also out of the balance 44%, 45% that we have, almost 60-70% of them have documented income. Now, the point is that we will continue to pursue that strategy in terms of focusing on a similar kind of a mix. Mix may slightly move towards more of self-employed borrowers, but that would not largely impact our overall mix on by the incremental basis. Self-employed contribution may increase a little bit, but on a portfolio basis, it will not have a significant impact. There is obviously been last 6-7 months we have seen some degree of impact on the interest rates, and we have seen the interest rates have started to come down, both on the asset side as well as on the liability side, as Naveen has mentioned. Our liability book has been repriced significantly, and therefore we will have to necessarily pass on some advantage to the customers as well. So while the margins will remain intact and NIMs will increase because of the increase in the disbursal that we expect if COVID challenges permit us but at the same time, the yield on the portfolio is expected to slightly reduce because of the impact of the competitive forces and benign interest rates in the market.
Coming to the liability side, what you said, so 2/3 is fixed floating and 1/3 is fixed. So basically, what we have done is, to add to what Arvind said, is that we have also started offering semi-fixed rate loans to our customers in last year. So where basically for the first 3 years, the interest rate is fixed and then it is floating. So that takes care of our interest rate sensitivity as well, and at the same time also gives some cushion to the yield given the benign interest rates in the market.
So if I may ask, the question that is bothering me, the issue that's bothering me is, you have a prime rate mortgages at 7% and your yield with 70% being documented customers is 14%. It seems too wide. Where is the juice? What is the secret sauce for those customers? And won't they go to another person who's offering, let's say, a 10% yield on mortgages? That's the question I had.
So if you look at the balance transfer rates, they are pretty much of our organization in terms of what is the BT out for the last 1 or 2 years. If you look at those trends, they are pretty much in line with the trends of the market, of the industry itself. So about 0.2-0.3% per month, is the BT out rate, and we also do fair degree of BT in accordingly. So balance transfer anyways is a part and parcel of the mortgages business. It is irrespective of the segments in which you operate. And second point is that, as far as documented income is concerned, it does not necessarily mean that, just because a customer has a documented income, so, the target market segment within the documented income also for different banks is different. The opportunity of the market is huge in terms of the kind of customers that we target. We look at more of low income group, economically weaker section, even though they have documented income. Ticket sizes are very different in nature because we are at around 7 to 8 lakh ticket sizes. So when we look at the universal housing finance companies, their target market customer in terms of ticket size and in terms of even the documented income is fairly different in nature. So they look at a very different profile of documented income customers. So while the balance transfer is a reality in housing finance business, but that is a part and parcel of your business plan, and you take it into cognizance when you are kind of making your business plan. So about 0.2-0.3% of balance transfer out is a reality, and it will always continue to happen. And you will have to keep building up your book accordingly, given that reality of balance transfer. As far as majority of our book continues to be floating rate in nature, and so therefore the interest rate risk always lies with the customer. And as I said, that our customers are basically low-income group customers and economically weaker customers, and will continue to pursue that strategy of underwriting these customers. Even though they have documented income, it is not that cases are approved without personal discussion and without meeting the customers. And also then the nature and type of properties that are involved are fairly different than what typically the universal housing finance companies target. So they usually do a lot of builder under construction kind of a property. Our percentage of under construction, if you look at our incremental dispersal, also has substantially come down. So focus is more on self construction, resale, and kind of such kind of transactions.
Just to add, almost 35% of our customer base is new to credit segment, and almost 80 to 90% of our customers are buying taking their first housing loan. So because of that also, because there is no competitive pressure from the banking channel also. So there we are able to command higher interest rate.
And these would be eligible for the subsidy under the government schemes, right, sir?
Yeah, absolutely.
Yeah, absolutely.
Thank you very much, and I really appreciate this. Thank you.
Thank you. The next question is from the line of Rahul Bangadia from Lucky Investment Managers. Please go ahead.
Thank you for taking my question, sir. Just a question on the asset management side. You have mentioned in the presentation of accrual of 22 crores in the quarter. How do you look at it from a steady state point of view? Is that 41, 42 basis points of that range is the thing that we should look at, or there is something on the mix that will change, or is there something that will help this creep up every year?
The presence of passive in the denominator is smooth. You should get steady state.
Sorry to interrupt you, sir. The audio is breaking from your line.
Am I audible now?
No, sir. It's still breaking.
Okay. This is the best I can do, I think.
Now it is a little bit better.
Okay. So basically, if you fix the passive, AUM from the denominator, then the rest of the business dynamics remain quite steady state. Also, the performance fee varies from year to year. So this year, obviously, last year, for instance, there was no performance fees because markets collapsed in the March quarter. And this year there was a performance fees because of the strong performance of the markets for the year as a whole, right? So X the performance fees and removing the passive business from the denominator, you should be able to get a steady state. Now, as and when you see the AUMs, growing as flows start coming in, the OPEX obviously will have a meaningful leverage, like you've seen for, most of the other bigger AMCs. So if you compare our OPEX to assets ratio, will be on the higher side given the smaller scale, compared to the bigger AMCs.
Right. Okay. Thank you. Thank you very much, Anand. Thank you.
Thank you. The next question is from the line of Nishit Shah from Equitas Investments. Please go ahead.
Good morning, sir, and congratulations on good set of numbers. Sir, I wanted to understand that margins in the broking segment this time were lower. So any particular reason for this?
So actually, margins in this quarter, if you are specifically referring to, and basically because quarter 4 also includes the impact of the variable pay, which is actually catching up over the course of the whole financial year based on the targets. So that is one of the reasons where you will see this. However, on an overall year-on-year basis, full year basis, if you see, the PBT margin is up by 300 basis points in FY21 over FY20. And that also includes the investment that we have made of about 1,600 employees in our business across north and south geographies, basically. So if you actually remove this whole impact, then actually there is a 500 basis operating leverage impact in the P&L on a year-on-year basis.
Okay. Then, sir, I want to come on investment banking side of the business. So over there, how do we see the pipeline and what is our outlook?
Yeah, so we are looking at a reasonably good pipeline and a hopeful turnaround on this business in the coming year from the losses that you've seen that we reported in the last year.
Okay. And sir, my last question is on our AMC business. So our total AUM is approx 46,000 crores. And does this include the 7,000 crores of passive AUM or that is different?
It includes that. There's a double counting in that number because we have a fund of fund on NASDAQ, which in turn invests in the same fund, right? So the actual passive AUM would be lower to that extent.
Okay. And sir, lastly, if you can give us gross and net flows for mutual fund and PMS business for this quarter. Thank you.
Rakesh?
So there is a net flow of 4 billion in mutual fund in Q4.
Sorry, I did not get the voice clearly.
With net sales of 4 billion in Q4 in mutual fund.
Okay, and PMS?
PMS, there is outflow. Almost 10 billion outflow.
Yeah.
How
you want 10 billion.
10 billion. Okay. Thank you, sir.
Thank you. The next question is from the line of Kajal from ICICI Securities. Please go ahead.
Hello. Hi, good morning, sir. So just two questions. One is on the retail broking where you have got the client traction. So how much is that acquisition for smaller regional brokers that you have mentioned? So how much of traction will be because of that, and how much it has further also added on the volume side? And the second question was on the alternate side. I just wanted to understand what has led to that strong performance this quarter.
Almost last one and a half year, we acquired almost 15 small brokers. And I would say almost 80 to 90,000 client addition would be on that basis.
Yeah.
Ajay, you can add further.
Yeah.
What is your next question, Kajal?
Yeah. So on the
alternate segment, how it has done well. So what are the factors there?
Yeah. So as stated earlier, so actually on the alternate side in the Q4, there was a performance fee impact which has come of 22 crore rupees at the overall net revenue level. And that is one of the reasons which is there. Plus, added to that, average AUMs have been going up as well. So average AUM is up about 4%. And there is also a performance fee impact which we charge on an annual basis, which is embedded in this.
So just one thing I wanted to ask, so whatever client addition that we are seeing now, so how much conversion rate that you are seeing into active generally? So
almost 40% is the conversion rate, which will make immediately active within a time frame of 1 month.
Yeah.
Oh, okay. Thank you, sir.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Nagendra Moria from Growth Capital. Please go ahead.
Hello. Yeah. Hello. Am I audible, sir?
Yes, you are.
Yeah, so thank you for the opportunity. Sir, just got a little question about your strategy of investing your profit in your own fund. Sir, how are you planning this strategy for going forward? Is there any plan other than that this strategy of investing your fund in your funds?
Hello.
So, yeah.
Hello.
Please go ahead.
तुम्ही ज्या व्यक्तीशी बोलत आहात त्याने तुमच्या कॉलला होल्डवर ठेवला आहे. कृपया तुम्ही ज्या व्यक्तीशी बोलत आहात त्याने तुमच्या कॉलला होल्डवर ठेवला.
Hello. Hello. Can you hear me?
Yes, sir. I can.
Okay. So I think what we have done is that whatever is the free cash flow year after year, that needs to be after free cash flow after dividend distribution. Whatever is the free cash flow that goes into two streams. One is basically private equity, I mean unlisted space, and second is the listed space, which is through our own AMC. So both of them, they keep, I mean, there is enough commitment onto the AIF floated by private equity and public mutual funds and all. So there are a lot of opportunities to invest in all this, and we keep looking for very strategic opportunity. So the liquidity, and we are also mindful of the liquidity of the investments. So if there is a need, if the need arises for $100 million, 500 crores, 1,000 crores to be invested in some operating business or any business opportunity, the fund should be available at fingertips to use that. So that's the broad objective. And as we go along, we are thinking of creating more vehicles of investing in the market, in private as well as in public side. So broadly, it is after whatever is left after dividends that will go into the markets.
Okay, sir. Thank you.
Thank you. The next question is from the line of Madhukar Ladda from Elara Capital. Please go ahead.
Hi everyone. Congratulations on a good set of numbers and thank you for taking my questions. First, a couple of ones on broking. So the market has been very supportive in the last 1 year, and we've added a lot of employees and our costs have also gone up. I just wanted to understand what is our fixed variable sort of cost structures in case market is not supportive. What sort of cost cutting we could do, and some color around that will be very helpful. Second, if you could give the revenue mix between cash and F&O, and there's a increase in these other distribution assets. Now that's almost 28% in the mix. Just would like to know what that is.
Yeah. So coming to the question of the fixed cost in the broking business, so actually in our broking business, if you see, there is a overall fixed cost between 40 to 45 crores a month. That is our fixed cost at which we are operating. For this, which is basically the fixed people cost and the administrative cost in this business. As you're aware, we also have a large portion of our business from franchising, which is a variable mix on the overall P&L. Yeah.
Hello.
Yeah, am I audible?
Your line is not clear. Maybe you could come a little closer to the mic or something.
Yeah, sure.
I can't hear you properly.
Yeah, sure.
Sorry.
Sure. So, I'll just repeat it. In our broking business, there is a fixed cost between 40 to 45 crores a month, which is the total fixed cost for the people cost and the administrative cost side, which is there. Rest all the expenses are variable, in the sense that our revenue sharing with our business partners is variable, and we also have a variable portion of the employee cost, which is there. So today as we stand, you already have about 90 to 100 crores a month of revenues and about 40 to 45 crores of fixed costs a month. So that is the operating metrics which is there, and rest are variable or discretionary costs to our things. That is the answer to your first question. I think could you repeat the second?
Second question is on the mix between the cash and F&O. It is 50% in terms of revenue. And your third question is on other asset in distribution product mix, right? So that is so that is mostly like the debt related product, like we have MLD and some debt products. So that is a part of other product mix.
Is it? Does insurance also come there?
No, insurance is not getting counted in AUM. Even though we have received even though we have received a very good response this year in terms of insurance, so almost 40 crore of premium business we did in this year.
Understood. If I got the number correct, PMS still saw outflows of 10 billion in the last quarter?
Yes.
In PMS, yeah.
Yeah. Can you explain what's actually happening on the ground? Markets have sort of recovered. There was a little bit of consolidation in the fourth quarter. And in general, the sentiment has been good, apart from the last probably 15 days of March. So why are we seeing outflows?
So if you look at the overall alternate assets, then the outflows less than that is probably between 8 and 9 billion, more like 8 billion rupees of outflow, because what is happening is that AIFs have gained in importance and have replaced, PMS sales to some extent, right? That's point number one. Point number two, the HNI segment, which is a larger customer of the alternate assets, is obviously, more conscious about the fact that markets have run up and there are risks and uncertainties. And we are seeing a lot more activity there across the board in terms of, profit booking. In our own alternate assets case, a lot of the AUM came in 2017-18 when, we had a, let's say, 3-year exit load, which is now over. And so sometimes that could also be a motivation which is specific to us. And finally, it could be our own, relative performance versus peers. So I think it is a sum total of all of these factors, that have contributed to the number that you saw.
Right. And what's your sense? How do you think this will play out? I know it's not, it's hard to predict this, but when do you think, this entire exit load phenomena will sort of get over, or people in the PMS side will continue to stick on?
I think that would be the least important of all the variables that I cited, right? But having said that, I think, comfort with market, our own performance, right? Greater traction in AIFs, because you must be aware that, AIFs require SEBI approval, and, there are the same product gets registered with SEBI for different distributors. So it's a lot more, operations and regulatory approval intensive. So to make the whole machine well-oiled, and it all started on the second half of this fiscal year, will take a little while. But we are quite hopeful that we should be able to turn this trend around, and there's some uptick in the performance.
Yeah, actually the line is very unclear, so I did not get that. Maybe I'll take this offline. I'm struggling with my line probably, yeah.
Sure, Madhukar.
Thank you.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Rajakumar V. Individual investor, please go ahead.
Yeah, good afternoon. Thanks for the opportunity. So my question is on the brokerage revenue. Congrats for the super growth that you've shown. I just want to know given the margin requirements are going to become more stringent go forward. So how do you see your brokerage revenue in the next 2 to 3 years? Will you be able to see a double-digit growth, or you're going to see some pressure here?
So I'll take this, Shali.
Yeah.
See, last year has been a very good year, as you know, and this new regulations on the margin came in from October and then December. So the first two things, there was no impact because the market momentum was on side. The March came the next impact, where we have seen some fall because of the margin requirement. We have got 2 more slides in June and September. Purely there will be impact on the F&O because that was where the option side, where there was a huge turnover happening based on the intraday margins, where the peak margins are coming into picture. But I see that going forward, the cash market will improve, the volumes will improve there. And we as a business is committed to this business from a long-term perspective, and the net additions of new clients, the way the whole penetration is still very low compared to what we can see. So we see that the growth can be there, but natural, the markets will have to be in our favor. If the markets are trending and it's in our side, so surely we should see growth. But looking at the last year's huge growth, we can see some amount of maintenance going forward for this year and the next year. But potentially the growth side is very much there. These are all norms. We have seen a lot of SEBI regulations which come into picture. These are short-term triggers, but in the long term, these are all good for the industry, and surely the quality of the volumes will improve going forward. That's what my take.
So you will be, my question is, will you be able to, demonstrate a double-digit growth in brokerage revenue in the medium term?
We are focusing that, surely. Surely you know that the volatility in the market can surely look at it different. But if the markets are performing, I don't see any reason why we cannot show double digit.
Okay. So just one more question on the dividend part. I know you're showing the superb EPS for the last 2 quarters. So would it be able? I was just thinking, it would be nice if you also increase your dividend yield. At least, if your stock, if you give like between 2.5% and 3% yield on your average market price, that would be good for a long-term investor, to stay invested.
That's not how we look at it. The way we look at it is the distribution as a portion of our profits. We have no control over market price, and trying to match some kind of dividend yield on the market price is not the way we work. So I think we have a clearly articulated dividend payout policy of 25 to 35%, and so our dividends will be in that range. Occasionally, in addition to the dividend payout, we also do a buyback, like you saw us doing it last year, and we've done it twice since our listing.
Okay. Thank you.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1.